Hello, I want to talk about VIX again today. That's the fear index, or this index that measures the implied volatility on a specific set of S&P 500 options. Now, you can check out other videos on VIX if you follow these links here. Today, I want to think about the fact that VIX is essentially protection against downside. And if it's that, should we just always hold it? Now, before we do that, I want to go back and think about, the VIX is measuring implied volatility. How does that compare to actual realized volatility? There's a lot going on in this chart here, but we have a realized volatility in blue, that implied volatility from the VIX, from the S&P 500 options in orange. The difference is that gray line there. And importantly, the average difference is positive, right? So it's 3.78%. We've got a standard deviation of 5.53%. So that two standard deviation line is plus or minus 11.05. But the key point here is that the average difference is positive, which implies that people in general overpay for VIX. It's not always the case, as you can see by looking at the gray line, but in general, people overpay. We can do the same thing by looking at that in percent terms. So in general, people are paying kind of 140% of what they should be paying for VIX. Again, people are overpaying for this. So in general, when you overpay for something, it doesn't turn out to be a good investment. Let's see what it looks like for VIX. So if we go and look at that, what we're going to want to do here is we're actually going to look at an instrument that tracks VIX. So that is this VXX. It's an exchange traded note. It actually invests in short-term futures on the VIX index, right? It's designed to track VIX, but that's how it actually works. If we look at the performance of that, so here's a chart. We go back. This is 2013 through 2015. Not a pretty chart. Definitely did not want to be long VXX back then. We can kind of jump forward here. We've got 2014 through 2018. Again, not a pretty picture. No, we do see some spikes in there, which are of interest. And in fact, what we can do is we can just kind of simulate VXX going back all the way to 2004. And we can see that this is, in general, not something you want to be exposed to. You would have lost basically all your money. On average, you're going to lose almost 60% a year just going long VIX. So again, not a very attractive thing. Now, so why are people interested in VIX? Well, here's the reason, right? So this is recent here. And we can see that although the trend is downward, there is a giant pop. Now, the giant pop, in case you can't see it, is this part right here, right? So this is kind of that pandemic sell-off. This thing shot through the roof. And so if you were long VIX during the pandemic sell-off, in this case, you actually long at the VXX, which mimics VIX, you would have done tremendously well. So that's why people are interested in this, because during extreme sell-offs, it does really, really, really well, okay? So this is all, again, it's all about fear, okay? And the problem is you pay too much for this fear and your worry. And so that in general, if you hold something like this long, you will not do well. The people that are selling this insurance, the people that are capitalizing on your fear are the ones that are going to make the money. Now, of course, if you go short this and there's one of those big market pops, it will not be fun. You could really, really get yourself financially hurt by doing that. Anyway, I hope you enjoyed this. Thanks so much. I am Brian Kozlowski.